So I don't know about you guys, but investing at the moment feels harder than it should. And I think that's for a number of reasons. But as I've kind of made videos before, with the stock market kind of hitting new all-time highs week after week, and then having a couple of little pullbacks over the last couple of weeks, I think there are a lot of people out there, certainly in my comment section as well, who feel that the market is overvalued, too expensive, and you have people who maybe are newer to investing, thinking about keeping money in cash, and people who are a bit more experienced also saying, yeah, I want to hold off a bit at the moment because it just feels a little strange out there, and it feels like maybe it's the start of the bubble. And I'm seeing this more and more, if you kind of watch a lot of finance YouTube content from both here in the US and the UK, certainly on those stock picking channels, and they'll create videos and they'll go through all of the financial metrics and they'll look back and they'll look at things like historical PE ratios. You've got the CAPE ratio, the cyclically adjusted PE ratio over many years, and say, look where we are now compared to the dot-com bubble and the global financial crash. Things are looking similar, or we're way above historical norms, historical averages, and they'll compare today to the 1950s, 1960s, 70s, 80s, 90s and noughties. And all of that creates a really compelling argument to think, oh God, they must be right. Therefore, I've got money now and I should probably wait, because who wants to invest at the top of the market, right? That's for mugs. Why not wait until there's this amazing crash, which has to come at some point, right? And that's the best time to deploy your money, in theory. And all of that sounds great, but I think you have to remember that this is all kind of living in la la land. It's extremely difficult, if not, it's impossible to predict what will happen next in the market. Now, one of the things I wanted to say on all of these videos, which you might come across and you might see from some creators, I would say mainly toward those channels which kind of pick stocks, is that there is no way to know if a company is kind of expensive unless you know the future, right? So a kind of a good example that I've covered before is that you can't compare the stock market of the 50s, 60s, 70s, 80s, 90s, and noughties to what we have in 2024, at least on basic stuff like PE ratios. I think that's an extremely poor way to look at the stock market, and mainly because companies of today generally are much more profitable and able to sell globally and scale a lot more than companies did 20, 30, 40 years ago. You can't compare a old school company who used to lead the way like an ExxonMobil or those oil energy companies, or some of the financials, with the Microsofts, the Amazons of the world now, who make enormously much more money in terms of profit margins and are in industries that can grow at double digits. Whereas you can't compare that. So you would expect a market to have slightly higher valuations now than they would do in the past. The markets are also much bigger than they were in the past as well. And I think there is always that danger. If you look back at valuations and compare it to what things look like now, I think, to be honest, you'd almost never start investing or get yourself money in the market, and you'd always be sat on the sidelines. And then it really comes to think, okay, well, how many times are you going to wait to find that crash? Here's a couple of interesting stats for you, because I wanted to understand, especially like all-time highs in the stock market. Well, how often do they happen? Now, apparently since around 1950, up until I think it was a couple of years ago, this data, but there's been over 1,250 all-time highs in the stock market. Now, since the data was updated, I reckon we could probably add a bit more of that over the last couple of years. But on average, per year, that's about 16 times per year, you will see all-time highs. Now, some years there'll be loads more, some years there'll be loads less. So that's more than one a month that we're going to see stock market all-time highs. Now, can you imagine if you don't invest at all-time highs? There'll be quite a lot of the year which you seemingly wouldn't be investing. And it's very, very odd. And now then also, on the flip side, what about times with kind of crashes and corrections and bear markets? Well, again, this is part of the market. And if you want those returns of the market, you have to put up with all of the times when the market's been in decline. Now, again, just out of interest on this one, just generally around that sort of same time frame from 1950 up until I think it was about 2022. Let me show you with a couple of interesting bits of data here. So in my head, I remember this by saying it's the 2-7-12 rule. So roughly every 2 years, the market has a correction. So around 10%, you'll see a decline in the market. That could be just inside the year. It doesn't mean the whole year has to be a negative one. Secondly, you have once every 7 years or so, you'll have a bear market, which means that the market declines roughly 20% or so. And then every 12 years or so, again, on average, but this could happen anytime, you're looking at a kind of market crash, which would be defined roughly kind of 30% more of a decline. So that means generally, if you have, say, a 30-year investing horizon, you are going to experience lots of these things. You're going to experience lots of all-time highs, probably, and you're going to experience lots of corrections, bear markets, and probably some crashes too. I mean, if you just think of that, right? You're going to experience a correction probably, 10 times? You're going to experience a crash 2 or 3 times. And the only way you're going to be able to make profit out of this and be a good investor is you're going to have to put up with these. And in lots of research that I read, I quite like some of the terminology that comes out that says the corrections, bear markets, and crashes, they're a feature, not a bug, which is quite funny, really, when you think about all the things we've gone through with the CrowdStrike glitch with world IT at the moment. And it's quite funny coming from that sector as well, seeing all the reporting on that one. But it's a feature, not a bug. The volatility in the stock market, the craziness that goes on is a feature because you've got all of these people coming together. We're all participants in the market and we're all just trying to guess what the best price is of something based on future returns. And the best thing you can always remember is that nobody knows what the returns are in the future. So we're all just trying to guess. Now, another thing I'd mention here as well is I think a good example, we've kind of gone from 2022 where the stock market was in a really bad bear market into 2023 and 2024, which has been kind of this extended bull market now. Now, I've been doing this YouTube thing since kind of mid 2021. And I remember 2022 very, very well because I was doing consistent videos. And definitely the comment section was very different to what it was now. And when I made the video about kind of where the market was, lots of people would say, well, the market's it's heading for another crash. It's got way more to go, 20, 30% more. I've got all my money in cash, or I've got all my money in gold because, the market's going to go down, guys. And it's very interesting, that human psychology element, how when the market was down and there was nowhere to hide in 2022, which was amazing as well. Both bonds had their worst ever year and the stock market declined more than 20%. So it's pretty bad. I think only one sector, if I'm not mistaken, I think the energy sector had a positive year, if I'm not mistaken. That would only be a very small sector and a very handful of stocks who had a positive return there. Almost everyone would have to have that decline in their portfolio. And then why would you stay invested if you truly believed that the stock market was going to crash? Of course, well, you wouldn't, right? You'd have everything in these safe assets, apparently. Now, I'd love to know, since that kind of corner got turned in 2023 and into 2024, where the same people are. Because I'd love to know how that psychology changes and if they manage to catch the bottom of the market magically toward the end of 2022. And just comes back to the point that point I wanted to make really in this video is that investing is hard. Doing this investing long-term thing is really, really difficult. And it's really, really difficult, even with all of the easy things and the kind of technology that we have nowadays. You just think how easy it is to invest, right? You can open up a brokerage account or an investing account from your mobile phone, set up something like an ISA here in the UK, invest for as little as £1 on some of these platforms, and you can then start investing so easily. You also have access to more funds and ETFs and stocks than ever before. It could not be easier and cheaper too. And yet, even with all of that knowledge and all of the history we have, most people will struggle to do that on a long-term basis. Now, and there's a reason for that, but the biggest reason really, it all comes back down to human psychology. Now, we're not really great long-term thinkers in terms of our little human chimp brains, unfortunately. Now, long-term investing is really hard. It's not easy, guys, right? We often quote as kind of financial and investing influencers, if you want to call it that horrible name, S&P 500 stock market returns globally has been kind of that 10% range for the last century or so. Okay, great, on a long-term average basis. But it's funny, that's what the market has returned, but the average investor, if you have a look at that kind of JP Morgan study, which is quite famous on this, the average investor gets nowhere near that. And you think, well, how do they get nowhere near that? Why? Shouldn't everyone just be investing into index funds? Well, I mean, I personally think most people should be doing that, but saying that and doing that are two entirely different things. And this really comes down to this ride and that feature of the market of all these crashes and corrections. So although you have this long-term chart that you can go back to and everyone says, zoom out and look at this long-term chart and you just have to stay in things for the long term, most people, the reality is they don't hold on. And the worst part is it really comes down to those bottom parts of the market and those, the real bottom parts of those crashes and corrections that people give up. And I guess ultimately everyone has a bottom point that they'll be able to see their portfolio and think, you know what, it's time to go. And if anything, unfortunately, they are, the worst parts for you to leave, really. And if anything, they're the times, in hindsight, of course, you should be buying and making sure that you dollar cost average into your positions. And another thing I wanted to mention as well, and I wanted to mention kind of quite an interesting story too, just to kind of wrap things up for you, was that because investing is so hard and most people won't do it, that first time that you invest, let's kind of say you are a beginner or a newer investor right now, and let's say you've got some money sat to the side, for example. I personally don't think it really matters whether you invest now, next week, tomorrow, or whatever, but I do personally have an answer to the question of when is a good time to invest. And I truly believe that the best time to invest will always be today, now, whatever the time you are watching a video like this. Because in the really long term, assuming you are a long-term investor and you want to regularly invest into the market, I strongly believe it's much more important to get your money in. And that famous old saying of, time in the market is much more valuable than timing the market, or making sure that you stay in the market is super important. Just think about this for a moment. Let's say some of the super investors and some of the greatest investors out there who have amazing track records. At any point during their career, can you show me where they pulled out entirely of the market and waited on the side with loads of cash? No, because it doesn't happen. You could justify and say, well, Warren Buffett has all of this cash. Well, if he truly believed there was a crash around the corner, he would sell out of all his assets, wouldn't he? Why would you invest in something like the stock market, for example, if you truly believed there was a crash around the corner? You wouldn't. What would be the point? Holding on to something that you knew was going to go down? This comes back down to the fact that no one knows what's going to happen next. And there's no guarantees with investing at all. Now, one of the other things I've been seeing recently as well, which kind of ties back into this whole theme of why investing is so hard at the moment. Another theme which lots of people are talking about is a rotation from large cap tech and all of the big companies into the smaller ones too. Now, the rationale behind that is because interest rates are going to be brought down around the world, here in the UK, over in the US, for example. And those small companies, which have huge potential to grow, also tend to have a bit more debt. Now, that debt has been more expensive since rates have been increased. So therefore, once those base rates get decreased, then their debt costs less to service, that they've then got this huge runway to be able to grow from. And all of that, again, sounds great, and it fills up the airways, and you can go and watch this on all your 24-hour news channels and financial content to your heart's content. And people are always saying, you know what, guys, now maybe is the time to rotate from big caps to small caps, and here we go, and let's make some money. But the reality is that all of this publicly available information is, quite frankly, already priced in. If you truly have an edge on the market, then you would have been doing this thing a long time ago and trying to predict what's happened. Now, I look back and I compare the S&P 500 to the Russell 2000, which is an index of the smaller companies over in the US. And I just went back to 2009 to 2019. So that's a good stretch of 10 years there where we had epic low interest rates, both really around across the world post-global financial crisis. Now, those two indexes, so the S&P 500 actually beat the Russell 2000 during that same time period, when I thought the whole argument was that during low interest rates, these small companies would somehow do really well. Well, actually, the S&P 500 did better. And it was quite a long way, actually. If you just have a look at the data here, the Russell 2000 did 203% over that same time period in total return, so everything including dividends. And the S&P 500 did 297%. So that's a huge sum of money better over that time period. And I'm sure you can go back and pick and choose various time periods when small companies have done better than big companies, but you know what? I don't bother with any of that, to be honest. I think it's good to know, and it's entertaining in some respects to go through all these things and know what's going on in stock markets and financial markets if you're interested. But then letting that change the way you invest, I think, is the big issue. And if you watch, financial news or here on YouTube, all the videos you can watch, you'd be changing your investment strategy every week, which is really some of the worst things you can ever do. Really, it creates great content and great videos which you can watch, and great thumbnail shocked faces, But the reality is changing the way you invest to try and guess and time the market is extremely difficult, if not impossible. I mean, just think of this as well. Okay, let's say you go along with the narrative that smaller companies, for example, are going to suddenly dominate and get the best returns. Well, how long does that last? So you sell everything now and move into small caps, and then when do you sell out again? You wait for everyone else to know that they're finished growing, and then you sell out and wait till the next interest rate rise happens and next crisis happens? I mean, I don't know. Right? It'll be up to you. But why? I just think, why bother doing all of that stuff? You just keep things simple, invest long term, and I think, I'll repeat again, you just keep things super simple and dollar cost average. And you have to do that whether times are low or times are high. But that is why investing is so hard. Now, another thing I was thinking of, one thing I'm interested in kind of outside of this whole YouTube space is I love running. So big runner, been doing it for a couple of years now, kind of more seriously the past like 18 months or so. Now running and so distance running and investing are so similar. Like you can make progress over, a few weeks or a few months, but the real progress in running and the real progress in investing comes years and years and years down the line. And it's not linear as well. You can make a lot of quick progress in running. If any of you started running and you tried to kind of get to 5K or get to 10K, half marathon, maybe some of you out there who do even longer distances. But, there's huge achievements. And after a few weeks and a few months, you might think, wow, I feel much better now and I can run further than I've ever run before. And I don't hurt. I'm not sore when I come back. But the only way to get better in those things is by doing it consistently over a really long amount of time. You think about this in running. No amount of money could cause you to be able to run a sub 20 minute 5K, a sub 40 10K, a sub 1 hour 30 half marathon, and a sub 3 hour marathon. No amount of money at any one point could actually allow you to do that. You have to put in the work. There's absolutely no cheat code and shortcut to success. And it's very similar with investing. Okay, you could argue with investing, you could get very lucky in one individual stock or some stupid play, but generally, we're talking here long-term stock market gains of an average person working dollar cost averaging into the market every time they get paid every month or something. That you have to do this for a very, very long time. And that time isn't measured in months or years, really, it's measured in decades. And it's also going to be an extremely bumpy ride. Again, when you zoom out and you look at yourself a few years back and think, wow, I started here, or I used to be this slow, for example, and now look at myself now. When I go back and look at my Strava, by the way, feel free to add me if you are a keen kind of enthusiast or running. I'm absolutely obsessed with it. I'm a bit of a nerd. So, you look back over the years and you think, wow, God, that used to be my kind of easy pace or my steady pace, or my heart rate was there, and now it's here, and you never look back. Same with investing. You think, oh wow, look where I am now, and look where I was just a few years ago or 10 years ago. It's crazy when you look back. But another thing you have to remember is progress isn't linear. There is no straight line with investing, although when you zoom out, it can look like it's straight and up. But when you do zoom into these different time periods, investing is really, really difficult. There are lots of simple principles when it comes to doing investing, but it is really, really hard. So I do understand and I get the feeling of why investing might feel difficult when you are riding these all-time highs and everyone's thinking, at least going back to recent times, of thinking there might be another bubble on the horizon. And there'll always be a bear case out there for why the market is suddenly going to crash. And don't mistake this as somehow that I am this uber bull and, like Tom Lee always gets dragged out onto these sort of videos, doesn't he? Because he predicted the market to go up. So therefore he must be right about everything and know where the market's going. Now, generally, yes, I would expect this global stock market to go up to the right, but that is over longer time periods because it's one of the best ways to build your wealth in effect. But there are no guarantees. Now, yes, with inflation, I would hope that, as prices increase and people's wages increase, and that will have a benefit to stock prices. But there is no guarantees that over 10, 20, 30 years that you'll be any better off. I would at least hope that we matched inflation, but the alternative to not investing is bleak, to be honest. It's staying in high interest savings accounts, or I don't know, gold, or you could choose other asset classes if you want. You could go into property, but the most effective and best kind of data that we have, and the most powerful kind of wealth creation tool that we have access to is a stock market that we have access to easier than we've ever had before to be able to get into. And there are no guarantees that what happens over the next few decades, but I would rather put my money there than put it anywhere else and spend less than I make, invest regularly as much as I can. And there is a bit of hope for the best there, but it's based on human ingenuity, progress, incentive, that there will be very smart people out there and clever people out there who are incentivized to create businesses, to get them on the public market and to grow them and to solve real problems and to create real value in the world. And I guess that's what I'm betting on when I invest every single month. So anyway, that's kind of a long-winded way of saying, look, I understand why it might feel like investing is really hard at the moment. And it's very easy to get sucked into what I call the kind of doomer side of YouTube, with people claiming that the stock market is expensive. But the problem with some of these guys is they're trying to sell either some kind of amazing stock picking course, which they're apparently really, really good at. But the reality is that nobody knows what's going to happen in the future. And we have to go back to those kind of foundations of investing. It's not exciting. It's really quite boring, some of the basics, really. It is that long-term dollar cost averaging into a diverse set of investments, which typically for me were going to be global index funds, but for you, that could be whatever you want. And doing that for a very, very long time. And it's going to be one hell of a ride, and hopefully I can join you with that ride as well. But look, I understand when people feel this way, and I can understand why you might feel this way, but I think people are going to feel this way every week, every month, every year for the foreseeable future. Letting that change the way you invest, I think, could be maybe the biggest mistake you ever make. But hey, that's just my opinion. I'm not a financial advisor, and I would love to know what you think in the comment section. Happy investing.